Hi, my name is Dr. Julian Tong. I just wrote an article on my blog about the stock market recovery in the United States and how we can make sense of it and what may come as a result of this recovery. Now, a little bit of background. Before there was this pandemic, a lot of people were already speculating of a depression-like recession in perhaps 2020 or 2021, no later than 2022. And this was because there was mounting debt problems across major economies, particularly in the United States, and I think also in China. This is in the United States, it's probably mostly corporate debt. In China, it's corporate debt plus individual debt. And it's very large debt levels, and with historically low interest rates, make it difficult for businesses to recover, for economies to recover once a recession hits. So these are basically the background. And as the pandemic hit, there were more people saying that perhaps there's going to be a depression, and a lot of people, if you go on the news, if you go on especially YouTube, where people are less judicious in their choice of words, they tend to throw the word depression around a lot. I think certainly is a possibility. A prolonged, a protracted period of low growth or no growth economically is possible. But let's just focus on the stock market. So far we just covered the background, right? We can talk about depression or recession in another video. Now, why has this U.S. stock market recovered so quickly? I think there are mostly three reasons. Right. The first was that the monetary policy, a lot of very loose monetary policy, and a lot of buying of bonds. So that's one thing. And the second thing is the fiscal policy, a lot of stimulus, right? And this at the time when businesses were just wondering whether they can continue the bond splurge. And the U.S. Congress made it possible for the big corporations to continue to borrow money at very little interest rate or no interest rate, and they get that money. They find that it's not really productive to use that money in anything other than to buy their own stocks. So the stock market goes up. And another third reason is that just as nothing is very few business activities are profitable these days. People look at a lot of investment that have already been made, and a lot of capacity that are there, a lot of capacities that are there, and perhaps there's not going to be enough demand, so putting more money into those activities may not be as lucrative. On the other hand, the stock market is a place where the more money you put in, the higher it goes. And if you get some stocks and more money will be put in after you have got the stocks, your price goes up. The price goes up and you make money. So stock market remains a bright spot in this a little bit somewhat bad situation, right? So I think one thing I didn't put in the article was that in this context, when we see a lot of corporations with a lot of debt. Not all the corporations, some of them are very good, but there are some industries where it's capital intensive, or when it's basically a sunset type of industry where demand is expected to come down over the years, but because the company have become so big, employ so many people, they are a crucial element of the economy. This makes it difficult for the government not to care about them, right? And they also carry a lot of weight in the economy. So what could happen, and this is not necessarily good, is that these companies already heavily debt-ridden, right? They probably can get some low-interest loans, maybe even at fixed rate, and this basically just keeps them going. But they're not going to make any money. They are going to keep a lot of production capacity, but they're not going to make money. Perhaps they're going to continue to make losses, and this is what is called zombie companies. So in the US, we could see a rise of zombie companies, and we can talk about this in another video. So with a lot of zombie companies, we might expect a repeat of what happened in Japan in the 1990s to now, what happened in Europe from 2007, 2008 to now. By the way, that's my printer. That's my printer making the noise. So that could take a lot of dynamism away from U.S. economy, and that may not be the good thing. Right. And what are the implications? That is another thing that I talked about in this video. What could be the implications of these developments? I think that there are three hypotheses. Right, not necessarily sure. These are basically my forecasts. People can disagree with me, and you're welcome to make a comment. The first was that structural issues such as inequality and the debt issue, these will be just swept under the rug and be ignored, neglected for the moment. And at the same time, we're going to see a speedy recovery of key macroeconomic indicators such as employment, GDP growth, right? Maybe investment levels. So we see a lot of macroeconomic indicators recovering very quickly and very beautifully, and that's the main goal of the government. They care about that. They don't necessarily care about the structural issues because those are long-term issues, tougher to handle, and don't yield good, big, beautiful numbers. And the second thing is that since this recovery will be focused on macroeconomic indicators instead of instead of necessarily addressing the structural issues causing the broad fallout of this crisis, we could see perhaps employment starting to change. I think while unemployment could come down, I have the feeling that perhaps employment will be less stable. It will become more flexible. There will be a lot of deregulation, and workers' rights will be weakened, right? Because all in the name of economic recovery. I don't think it matters whether it is the Republicans or the Democrats. It doesn't matter. There are some progressives in the Democratic Party, but I think they are maybe a minority, maybe 1/3 of the Democratic Party. So the main hold of the Democratic Party and the almost entirety of the Republican Party, with the exception perhaps of the Libertarians, they are gonna all care. None of them are gonna address the structural issues. So it doesn't matter who wins this election. And thirdly, I think the U.S. will be worse prepared for, grossly unprepared for the next crisis. And I think the next crisis will be one driven by climate change It will be either food, water, or some of the other natural resources that are related, that are negatively affected by climate change. And I think there's basically a total neglect of those climate issues. And I think there are, even in Europe, I think this is going to be true, because in Europe people talk a lot about climate change as if it is a way to make money. It is a way to make money. If you have the right technologies, you can make a lot of money. But it's not just to make money. It's about improving people's lives. It's about helping people maintain at least their current standard of living and improving it. But I think macroeconomics, or maybe policy making, have come to such a stage that people's lives don't matter as much as numbers. I think this is the sad thing that we can see about the development in using data. Data becomes an end instead of a means to an end. Data becomes the target instead of a measurement of how well we have fared. So that's all right. So this is the article. If I will put the link of the article in the description. So thank you very much for watching this video, and I will see you again perhaps tomorrow.